Welcome back to Four Corner Finance, where we help you navigate the world of investing, financial markets, and beyond. Today, we're diving deep into the Russell indices, specifically the Russell 1000, 2000, and 3000. If you've ever been confused by these terms or wondered how to gain exposure to these indices, this is the video for you. So first, we'll dive into the indices. The Russell indices are some of the most important benchmarks in the US stock market, tracking the performance of thousands of companies. The monikers 1000, 2000, 3000 can be confusing, so let's break down what each index is. And first, we're going to start in Yahoo Finance, again, free and accessible to everybody. And if you go into the search for companies, just type in Russell, and then go to show all results. You're going to see a number of options that can be daunting, confusing to some. You'll see the mini Russell 2000, 1000, 2000, see Russell 1000 repeat, 3000, 2000, etc. So what do these all mean? What's the difference between them? It's been a lot in the news lately. Some pundits like Tom Lee have talked about it. So I put together this table here to show us what the difference is. And we'll start with the Russell 1000, which is more similar to the S&P 500, except it's 1,000 companies. But it's a large cap index, 1,000 of the largest companies. There's some mid caps in there. You can see the market cap coverage is about 92% of the total US stock market. So the Russell 1000, like the S&P 500, covers a lot of the larger companies, your Apples, Microsofts, Nvidia's, Amazon's, Google, etc. And it's really been a benchmark for US large cap stocks, 1,000 companies, a little bit more than the S&P 500. The Russell 1000 goes into some more mid caps that the S&P will not cover. But often when you hear the Russell mentioned, especially lately in the news, oftentimes they're talking about the Russell 2000, which the Russell 2000 is all about small cap companies, smaller companies, growth phases. These are smaller, more agile companies, often overlooked, but can have huge growth potential when the time is right for them. And also you'll see in our Yahoo Finance search that we just looked at, the Russell 3000, which really merges the two together. It's a barometer of the broad US stock market, a combination of the 1000 and 2000. It's going to track the 3,000 largest companies, providing a broad view of the overall market. So again, essentially the Russell 1000 covers the big players. The Russell 2000 focuses on smaller companies. And the Russell 3000 gives you best of both worlds. It combines the two into one. So for investors like us, how do we gain exposure to these indices, and really specifically the Russell 2000? Many of us have large cap exposure through the S&P 500, and the Russell 1000 is certainly another index that you can add in lieu of the S&P 500 if you like a little more exposure to some mid caps, again, 1,000 companies versus 500, but has much overlap with the S&P 500, whereas the Russell 2000 is our small caps. So I ran this search. This is similar from Yahoo in Russell, and you could see I go over to the ETFs. You've got a few right at the top here. We've got ticker symbol IWM, which is an iShares Russell 2000 ETF, and we've got ticker symbol VTWO, which is a Vanguard Russell 2000 ETF from Vanguard. There's others here too, ProShares Ultra Pro. You've got Russell 2000 Growth, and some of these others that you can explore yourselves. But we're really going to focus on IWM and VTWO, the Russell 2000. So IWM really gives us IWM. Let's pull up IWM. IWM, the iShares gives us a Russell 2000 exposure very cheaply. You can see some of the metrics of it. Here's the 5-year chart. So it's really been in this long saucer pattern. But you can see the yield, 1.2%, similar to the S&P 500. And these are, when comparing ETFs that have comparable securities in them, the expense ratio is something to take note of. And so it's almost 20 basis points on the iShares index, or the iShares ETF for IWM, versus our Vanguard. Again, let's go to 5 years. And you can see a very similar pattern in performance. These two near identical ETFs holding the same securities. You see the yield very similar on the Vanguard, but when we look at this expense ratio, 10 basis points, the Vanguard is charging nearly half of what the iShares ETF is charging in terms of expense ratios. Both fine ETFs that give you broad exposure to small caps without having to pick individual companies. Again, not recommendations to buy or sell. If I were to choose to get some exposure to the Russell, probably lean with the cheaper of the two in the Vanguard fund that charges less than the iShares. If you click into some of the holdings on Yahoo Finance, you can see some of the top 10 holdings, the individual companies. Some smaller companies, maybe some you've heard of, maybe not. Sprouts is a supermarket that many of us have heard of. And you can look at some of these individual companies. You can see the sector weighting. Healthcare, 17%, financial services, some industrials, technology, round out the top holdings, consumer cyclical, and so on. So again, the Russell's been making the news often. CNBC, many pundits have been talking about it. One in particular is Tom Lee. Tom Lee, Fundstrat Global Advisors, often on CNBC, has been in the ranks of the news lately, making many predictions over the years that have come to fruition. Personally, I enjoy listening to Tom. He's a bright guy, knows the markets well, and good track record, good to listen to. So I can post the link to this YouTube video from CNBC in the description if you'd like to take a listen. We'll listen to a little bit of it, not too much, see what Tom says.
Explain why.
In the short term, markets are very sensitive to, especially the sector level, depending on whether it's a Republican or Democratic taking the White House in November, and then especially all the congressional elections and state elections. So I think that's what you saw last week, is as probability shifted towards Trump, small caps, industrials, financials rallied.
And you're sticking with that call, which is for what, 40% over 10 weeks?
The overlap is small caps are very sensitive to a Fed cut, and really the probability of a Fed cut, that it's finally happening. And I think it's going to look like the October to December 2023 rally, which was almost 30%. This one should be bigger because of the amount of short positioning and the amount of oversold in the Russell. So yeah, 40% by the end of the summer.
I just want to dig into it. Does it make...
Okay, so you heard Tom Lee there. He's predicting the Russell could surge by as much as 40% over the next year, end of summer. We're rapidly approaching the end of summer here in September. But he's predicting a large surge in the Russell. What's his reasoning? You heard there, Federal Reserve starts cutting rates, interest rates. Smaller companies that are more sensitive to borrowing costs will have a much easier time growing. He thinks the index itself is oversold. And according to Tom Lee, this environment could cause a rally in small cap stocks, which are very well represented in the Russell 2000 index. So Lee's optimism highlights the growth potential for the small cap space, particularly if we see some relief from interest rates. But why are small cap stocks like those in the Russell 2000 so sensitive to rates? Great question. Small cap companies often rely more heavily on borrowing for expansion and operations compared to their larger counterparts. When interest rates are high, it's harder for them to get cheap loans, which limits their growth. However, if the Federal Reserve starts to cut rates, as Tom Lee and many others are predicting, this could act as a major tailwind for these companies and send the Russell 2000 soaring. So, question to ask as an investor, is now a good time to invest in the Russell 2000? And again, we're not making recommendations to buy or sell any securities here. Everybody's best interest to be in, have some kind of investment mindset for the future. And while no one can predict the future with any certainty, folks like Tom Lee are bullish, and his outlook suggests that small cap stocks might be in for a big rally. So if you're looking for growth opportunities and believe that rate cuts on the horizon or are on the horizon, now could be a great time to look into these two ETFs like IWM from iShares and VTWO from Vanguard. Again, my personal preference of the two is there's a lot of overlap between the two and have comparable performance. Why not go with the fund that's charging you a lower expense ratio, VTWO? But that, again, up to you. They're both fine options to gain exposure to U.S. small cap companies. So thanks for watching Four Corners Finance. Don't forget to please like and subscribe. Hit the bell for notifications and updates on the financial markets. Let us know in the comments, too, if you plan to invest in the Russell 2000 or other small cap stocks, other small cap indexes. Thanks, and see you next time.